In terms of selection criteria and why those 11, very basic actually. It's a combination of having good demographics, which basically just means a lot of people and young people, and having the growth conditions in place to take that demographic dividend and propel themselves to become big and important economies. And on the human capital front, I said having lots of people and young is important, and it is, but if they're illiterate and they die early, that's obviously not good for growth, right? So we need to make sure that these people are educated and have good life expectancy. And so those are things that we measure and care a lot about.
Exits are very, very difficult in a pure private equity setting. If you invest as pure equity as well, what will kill you most likely is your exchange rate, your currency devaluation, and your inflation. And the third thing why private equity typically also is difficult to work in these countries is you have an incredibly high debt interest rate from the local banks. So you cannot build a business, in my view, when you're borrowing at 30%. It's incredibly difficult. It's cheaper in a sense to raise equity rather than debt. It goes against all conventional economic wisdom.
When you look at the grouping of countries that we're focused on, I mean, there's over 170 countries in the world that are non-developed. So, yeah, very vast, broad opportunity set. Themes that we continue to focus on are infrastructure and consumption. And in the markets that I named, the good news is that the vast majority of the public equity exposure there is actually geared into the consumer. The theme within the theme, and this is very much in line with what Zain said earlier, is consumption. This is by far, we think, going to be the most transformational theme across these countries over the next decade.